The Federal Reserve just increased interest rates by another 75 basis points. The stock market tanks in reaction to the Federal Reserve's outlook, and mortgage rates are now at 20-year highs. What's up, guys? This is Oliver, your Bay Area Realtor, and for today's video, we're going to be reviewing the Federal Reserve's most recent federal rate hike in their 6th meeting and how it has impacted our overall economy. Before we begin, if you're new to this channel, my name is Oliver. I'm a realtor in the Bay Area and I create content on the latest news revolving the real estate and mortgage market nationwide and how that ultimately impacts our beloved Bay Area real estate market. If you enjoy me making these videos, I'd appreciate if you like the video and feel free to subscribe and hit that bell icon. This will help support my channel and help home buyers and sellers like yourself who want to stay updated with the Bay Area real estate market. Now with that out of the way, let's cue up the intro. So now, guys, we are at my computer screen, and right here I have the Federal Open Market Committee's Chair Jerome Powell's press conference that he held at the end of his meetings with the Federal Reserve on September 21st, 2022. I highlighted the main points of what he discussed in his speech. Here we go. So to start off from the top, today the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. So we saw during the pandemic that consumer spending dramatically increased. In addition, there were labor shortages and structural factors that caused an array of supply chain issues. This was all elevated even further with the conflicts in Russia and Ukraine, and also the COVID-19 lockdowns in China, which affected the supply in sectors like consumer goods, metals, food, chemicals, and other commodities. Also, the rate hikes from the Federal Reserve affected the housing market. At the start of the FOMC meetings, the housing market cooled down, with mortgage rates reaching highs not seen since almost 2 decades ago. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low. Job vacancies are near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding supply of available workers. The labor force participation rate showed a welcome uptick in August, but is little changed since the beginning of the year. So they're saying that the labor market has been doing exceptionally well in spite of the economic slowdown that we're experiencing. They mentioned something really interesting where they said that demand for workers is more than the actual supply of available workers. And right now, unemployment is at a 50-year low at 3.7%. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep long-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we are confident the job is done. So remember guys, the Federal Reserve's job is to control the economy and to make sure that the monetary policies that they're enforcing help stimulate the economy in the right direction. And right now they're seeing that they're seeing that prices are too high and inflation is too high, and they want to control it. They want to control it by setting the target rate for the federal funds rate higher, and they want to tighten inflation so that it goes back down to 2%. If you haven't seen my last mortgage market update video, I went over the most recent inflation report that was released by the Department of Bureau and Labor Statistics, which found that the inflation for August was 8.3%. A lot of economists and experts predicted that it was actually going to be 8.1%, so it was slightly higher than what they were expecting. If the FOMC believes the economy is growing too fast and inflation is too high, they will set the target rate higher to control economic activity. On the other hand, they will set a lower target federal funds rate to spur greater economic activity. So Jerome Powell and the Federal Reserve really emphasize on their focus to tighten monetary policy, and it's mostly related to how unemployment is at an all-time low. I have this really good article by the CBS News, and the article is titled "Buckle Up, America, the Fed Plans to Sharply Boost Unemployment." Starting from the top, in case the US economy wasn't hurting enough already, the Federal Reserve has a message for Americans. It's about to get much more painful. Fed Chair Jerome Powell made that amply clear last week when the central bank projected its benchmark rate hitting 4.4% by the end of the year, even if it causes a recession. Jerome Powell said, "There will very likely be some softening of labor market conditions. We will keep at it until we're confident the job is done." The Fed forecast the unemployment rate to rise to 4.4% next year from 3.7% right now as of today, a number that implies an additional 1.2 million people losing their jobs. Here's the idea why boosting the nation's unemployment could cool inflation. With an additional million or two people out of work, the newly unemployed and their families would sharply cut back on spending, while for most people who are still working, wage growth would flatline. When companies assume their labor costs are unlikely to rise, the theory goes they will likely stop hiking prices. That in turn slows the growth in prices. What this article is saying is that basically when unemployment goes up, there are less people working, and with less people working, wage growth is slowing down, and with that labor costs go down for a lot of businesses. And with the unemployment increasing and then less labor costs for the business, they will decide to stop hiking prices and slow down the growth in prices. So right now we're in this kind of dilemma where inflation is really high at 8.3%, and workers are demanding to stay ahead of inflation. However, since inflation is already at 8.3% and worker pay has only risen on an average of 5.5% over the last year, their pays have been eclipsed by higher prices due to inflation. When rates rise, any consumer item that people take on debt to buy, whether that's automobiles or washing machines, gets more expensive. That means less work for the people making those cars and washing machines, and eventually layoffs. Other parts of the economy sensitive to interest rates, such as construction, home sales, and mortgage refinancing, also slow down, affecting employment in that sector. In addition, people travel less, leading hotels to reduce staffing to account for lower occupancy rates. Businesses looking to expand, say a coffee shop chain opening a new branch, are more hesitant to do so when borrowing costs are high. And as people spend less on travel, dining out, and entertainment, those hoteliers and restaurateurs will have fewer customers to serve and eventually cut back on staff. In the service economy, labor is the biggest component of your cost structure. So if you're looking to cut costs, that's where you look first. So this is a great article that explains the relationship between inflation and unemployment and how increased prices can affect unemployment. You see right here, I have pulled up the United States unemployment rate from Trading Economics. Right here, it shows Right here it says the US unemployment rate rose to 3.7% in August of 2022, the highest since February and above market expectations of 3.5%. The number of unemployed people increased by 344,000 to 6.014 million, while unemployment levels went up by 442,000 to 158.732 million. You can see right here, this was during the pandemic, increased all the way to almost 16% unemployment rate. And then once people started going back to work and unemployment started decreasing, it went all the way down to 3.7%, which is right now, which is very low. Actually, it's almost as low as it was low before the pandemic. If we look before the pandemic, even further, it wasn't this low since late 1960s, early 1970s. So now let's move on to how the stock market and Wall Street has reacted to the Federal Reserve and their increases to the federal funds rate. There's an article by Reuters called "The Wall Street Slumps as Investors Absorb Hawkish Fed Rate Message." We can start from the top. September 21st, Wall Street's main indexes seesawed before slumping in the final 30 minutes of trading to end Wednesday lower as investors digested another supersized Federal Reserve hike and its commitment to keep up increases until 2023 to fight inflation. All three benchmarks finished more than 1.7% down, with Dow Jones posting its lowest close since June 17th, with the Nasdaq and S&P 500 respectively at their lowest point since July 1st and June 30th. At the end of its two-day meeting, the Fed lifted its policy rate by 75 basis points for the third time to 3 to 3.25% range. Most market participants had expected such an increase, with only a 21% chance of a 100 basis point hike seen prior to the announcement. However, policymakers are also signaled more large increases to come, in new projections showing its policy rate rising to 4.4% by the end of this year before topping out at 4.6% in 2023. This is up from projections in June of 3.4% and 3.8% respectively. Rate cuts are not foreseen until 2024, the central bank added, dashing any outstanding investor hopes that the Fed foresaw getting inflation under control in the near term. The Fed's preferred measure of inflation is now seen slowly returning to its 2% target, but in 2025. In his press conference, Jerome Powell said U.S. central bank officials are strongly resolved to bring down inflation from the highest levels in 4 decades and will keep at it until the job is done, a process he repeated would not come without pain. So we can look at the S&P 500. So before the meetings, it was at 3,899, and after the meeting on September 21st, it dropped to 3,789. As of now, is continued to drop down to 3,647, which is the lowest of the year. Same thing with the Dow Jones. Before the meetings occurred, it was 31,019 on September 19th, and then after the meetings it was 30,183, and now, as of now, it's at 29,683, which is still almost at the year low. So let's look at the US 10-year Treasury note. Right now it's at 3.736. You can look at it for the past 1 month to see the chart. So right here, September 21st, after the end of the meetings, it was at 3.531%, but after it has spiked up all the way to its highest at 3.948%, and now it went back down just slightly to 3.736%, but this was the highest in a year. Look at that, 3.948%, almost 4%. Look at 3 years. It's been the highest for 3 years. And we haven't seen Treasury yields this high since 2011. The US 10-year Treasury note has a correlation with mortgage rates. The higher the Treasury note is, usually is the higher the mortgage rates are. And as you can see, it has spiked up since the beginning of the year, and same with mortgage rates that also have spiked up for the beginning of the year of 2022. So now let's look at mortgage rates. I have right here the most recent mortgage rates from Mortgage News Daily. Right now, the 30-year fix is at 6.82%. 15-year fix is at 6.13%. 30-year jumbo is at 6%. 5-to-1 ARM, 5.99%. 30-year FHA, 6.5%. And 30-year VA, 6.5%. So our 30-year fixed is almost at 7%. Actually, today actually went down, as you can see, by 0.26%. You can see right here, you can see the highest it has been for a 30-year fix was on September 26th. This past Monday, a 30-year fixed mortgage went up to 6.92%. And if we look at Freddie Mac's economic data, if we look at here, this is not from the past Monday, but from the past last Thursday when it was at 6.29%. If it was at 6.92%, it wouldn't have been that high since 2002, so nearly 20 years ago. So like I said, the Federal Open Market Committee meets 8 times to review the economy and to see if they need to tighten or relax monetary policy. Right now, we've already had 6 meetings all the way up to September. We're going to have 2 more meetings, one in November 1st to the 2nd, the last one in December the 13th to. So the current target rate is 300 to 325 basis points. This graph shows the probability and likelihood the Federal Reserve will increase federal funds to less than 375 or more than 375 basis points. As you can see right here, it's almost nearly split, with 47.8% likelihood that the federal funds rate will be below 375 basis points, and 52.2% seeing that it will be higher than 375, up to even 400. This is probably a reaction to the hawkish outlook from the Federal Reserve and Jerome Powell's messaging. So I hope you guys found this video informative. If you did, please like the video. It helps my content reach others that may need this information. And feel free to subscribe to stay updated with all things real estate in the Bay Area. I'll see you guys soon.